Hey, this is not the fourth blog. This is a quick follow-up to the last blog, so I'll call this blog 3.5. But I want to also stress that all bonds are not created equal, and companies such as Morningstar and Standard & Poor, they give what they call credit ratings for bonds, and Standard & Poor it represents the most popular of the ratings. And anyway, a AAA to a AA bond is considered a high quality bond, and that bond is a bond issued by a company with a strong credit history, strong financials, and usually will pay a decent rate but not as high as other bonds because of the stability. The next class of bonds is AA to BBB, which is medium credit rating. Will give you a higher interest than a AAA to AA, but with the higher interest comes, more risk. And anything below a BB to BBB, that's considered a BB to B, that's considered a higher risk bond, also known as a junk bond. Now, with junk bonds, you get higher interest, but with the higher interest come risk. And I tell people that, when you look at the numbers and you want to get a higher interest, higher return, usually higher returns come with higher risk. Now, if you are the brave ones and want to invest in junk bonds, I say invest in junk bonds through a fund. And what I mean is that invest in a mutual fund or an index fund that concentrates on purchasing different kinds of junk bonds, and investing in multiple junk bonds through a fund hedges your risk amongst defaulting from one bond. You don't, especially when you're moving towards dealing with junk bonds and high return, you want to hedge your risk of default by investing through a fund that purchases multiple junk bonds, because the money spread out amongst multiple bonds makes it less risky for you. But that's my quick follow-up on the bonds. The next thing I would like to talk about is blue chip stocks, investing in blue chip stocks, as well as things to avoid. I would say quickly, last thing I'll say on this half a blog is, you don't want to. People hear about penny stocks and you think to yourself, I can purchase $2,000, well, not sorry, $2,000, but 2,000 shares of a penny stock, and then the chances of me making money is greater because of the number of shares. But penny stocks are very volatile. So, from my experience, for every one penny stock that made me money, 4 or 5 made me throw money away. And when you combine that together on your return, you usually do worse than possible. I sign up for all different kind of financial emails that send me, oh, this stock is hot, that stock is hot, but I never purchase a stock just because people are saying it's hot. I analyze, why is this stock hot? I look at its financials, I compare it to its ratios, I compare it to, its market cap and different things like that. And I'll discuss what all of those things mean at a later blog. But I just want to follow up real quick. And I know this blog was longer than it should have been, but I love helping you guys. Once again, this is Morvis Bonham on smallmoneybigdreams.com. Once again, the email is smallmoneybigdreams@gmail.com. See you guys on top.